In the previous lecture, we tried to brainstorm an intuitive approach for valuing options. We're going to use the option on the orange as sort of an intuitive basis to guide our exploration to modern options, which are usually on financial assets. So we're going to recall some important terminology. So in the previous lecture, we talked about things like a sample space, which you can think of as a set of possible outcomes. And then we talked about a probability measure, which is the way you assign each of these outcomes a specific number. Then we talked about utility, which is going to be very important as a measure of well-being. And then, of course, preferences, which is that each individual across time may have different versions of utility for the same outcome. So now we're going to start with the simple definition of the modern option. An option is a contract that allows the holder the right to buy or sell an underlying asset at a specified strike price on or before a specified date, depending on the form of an option. An option that conveys to the holder the right to buy at a specified price is referred to as a call, while one that conveys the right to sell at a specified price is known as a put. The underlying asset for most options are usually publicly traded stocks such as Apple, Tesla, GameStop, or commodities such as crude oil. Oftentimes, people buy these options as a way to get specific exposure to or hedge against future price movements of the underlying. So now we'll talk about the payoffs of the call option and puts. So at expiration, the terminal value of a call option is just the maximum of the stock price minus the strike price or zero. So basically, if the strike price is higher than the stock price, the option would expire worthless and your payoff would be zero. So you just lose the premium basically. Similarly, for a put option, it's the strike price minus the stock price. And if the strike price is higher than the stock at expiration, your payoff is zero and you just lose the premium. This is because options give you the right, but not obligation, to buy the underlying at the specific strike price. So let's try and visualize this. Here's a couple of graphs to plot the payoffs. So in the first one, we have a long call. So if you buy a call option, your profit is, it's going to start out negative, right? Because the option is presumably out of the money. And as the stock price increases, your payoff will start to increase, and then eventually you'll break even. So X here is the strike price, and that's when it becomes sensible to start buying at expiration, and then eventually you break even, and then you start making money. And then conversely, for a put option, you pay the premium, and then as the stock decreases, your payment will, well, as it decreases beyond the strike price, you start to make money, and then that's your payoff. And then, you can short these options, and then the payoff would be basically the inverse. So here's just a concrete example. Let's suppose there's a option with a strike price of 100 and an underlying price at maturity of $110. So for the call option, the payoff is S minus K. So it's 100 minus 110. That gives you $10, which is greater than zero. So you take the maximum, which is $10. However, if it were a put, the payoff would be $100 minus 110. That gives you negative 10. So in that case, you wouldn't exercise the option, and it would just be worthless. So you would just take 0, which is higher than negative 10, and your payoff would be 0. So it's pretty clear that what an option is worth at expiration, because we know it's just S minus K or K minus S. So the question is, how do we price an option before its expiration is up? This is the fundamental question in our course. So let's just try to, think about what would be some useful ways to value this. So the most important thing that you're probably thinking of is, well, let's just try and think of where the stock will be in the future, and then, we can sort of define a sample space off of that. If we knew where the stock was if we knew exactly where the stock would be, then we could calculate the value of the stock. But unfortunately, we don't know the future, so we're going to have to use a bit of statistics. We can call the stock price at a future date a random variable. And then the sample space for this random variable is just a number from 0 to infinity. That's because stocks can only be from 0 to infinity, right? So think of the orange example. What's the next thing that we would want here? The next thing we would want are probabilities. So we need basically a list of probabilities to go with our sample space. If we had both of these, we could basically calculate the expected return, and maybe we can argue that, well, if we calculate the expected return, and if it's higher than whatever the option is currently traded at, uh, then we can recommend buying the option. However, it turns out that this type of pricing model is not how it's priced on the market. The reason why? Utility. So we forgot to take into account the utility. It's really the utility that determines whether or not we buy an option, not necessarily the expected return. So let's just take a concrete example. Let's suppose there was an option that cost $100,000 and it expired in 2 years. Now let's just suppose that I knew that the expected return was $100,000 on average. A normal person would actually refuse to buy this option for $100,000 because, there's a probability, right, that maybe you actually lose all your money. And in general, people hate losing money more than they like gaining the same amount of money. We just call this phenomenon risk aversion. So let's just give a concrete example. So imagine like if you're entering the lottery. The lottery pays either $10,000 or you lose $10,000 with equal probability. While the expected return is zero, a risk averse investor will assign a negative utility to this and reject it. The reason is, well, if you lose $10,000, your life is probably ruined. And so we generally try to stay away from these types of lotteries. So in order for him to buy this lottery, you would have to kind of skew these probabilities to the upside. In other words, we kind of need to distort the probability measure into something else. However, basically the problem we're at here is if the option requires us to take into account risk preferences, then that would in principle mean that there's no objective way to value it. It just depends on, risk preferences of the investor. However, luckily there is a solution, and with a little bit of math, we can actually come up with a specific price.